Time to make sense of shillings and cents in business. Kenya has sealed a preliminary trade agreement with China to allow 98.2% of Kenyan goods to enter the Chinese market on a duty-free basis. Trade Cabinet Secretary Lee Kenyanjui says the deal follows bilateral engagements aimed at expanding Kenya's export basket and addressing long-standing trade imbalances.
Kenya now, the country has struck a preliminary trade agreement with China that allows 98.2% of its export goods duty-free market access. Now, this all according to the Kenyan Trade Ministry that says the two sides have been holding discussions for a full bilateral trade deal. Key products include coffee, tea and cut flowers. Now, while the deal provides an immediate boost for key agricultural.
A major trade shift is unfolding, and it is drawing attention far beyond East Africa. Kenya has moved closer to granting China roughly 98% duty-free access to its market under a new trade arrangement. The development is already raising questions about the future of U.S. influence in Africa, the direction of Kenya's trade policy, and how global economic power is slowly being rearranged. Here are the facts as they stand. Kenya and China have been holding advanced trade discussions aimed at deepening economic cooperation. These talks build on existing frameworks between China and African countries, especially those linked to infrastructure, manufacturing, agriculture, and technology. The new arrangement would allow the vast majority of Chinese goods to enter the Kenyan market with little to no import duty. In return, Kenya expects expanded access to the Chinese market for its own exports, particularly agricultural products, tea, coffee, flowers, and manufactured goods. This move did not happen overnight. Kenya has been working to diversify its trade partnerships for years. China is already one of Kenya's largest trading partners and a major source of financing for roads, railways, ports, and energy projects. Trade volumes between the two countries have steadily grown, even as global trade tensions and supply chain disruptions have reshaped markets worldwide. At the same time, the United States remains an important partner for Kenya, especially through initiatives focused on development assistance, security cooperation, and trade frameworks, like the African Growth and Opportunity Act, known as AGOA. However, AGOA is not a free trade agreement. It is a preference-based system that can be reviewed, changed, or withdrawn. Many African policymakers have openly expressed concern about its long-term predictability. Kenya's discussions with China are taking place in a wider African context. Several African nations are rethinking how they engage with traditional Western partners and emerging powers. The African Continental Free Trade Area has also encouraged governments to think more strategically about trade, value addition, and industrialization. In this environment, Kenya's decision to deepen ties with China is seen by some as a calculated economic choice rather than a political statement. Still, the scale of the proposed duty-free access is what makes this development stand out. 98% is not symbolic. It represents near total market access. Analysts warn that such a move could significantly reshape Kenya's import landscape, affecting local industries, pricing, and competition. Chinese manufactured goods, already known for competitive pricing, could become even more dominant in Kenyan markets. Supporters of the deal argue that cheaper imports could lower costs for consumers and businesses, boost infrastructure development, and strengthen Kenya's position as a regional trade hub. They point out that Kenya is seeking growth, jobs, and industrial capacity in a challenging global economy. From this perspective, closer economic ties with China are seen as practical and growth-oriented. Critics, however, raise concerns about trade imbalances. Kenya imports far more from China than it exports. There are fears that increased duty-free access could widen this gap, putting pressure on local manufacturers who may struggle to compete. Analysts warn that without strong safeguards, industrial policy, and export diversification, Kenya could become even more dependent on imports rather than building domestic production. This brings us to the broader geopolitical implications. The United States has long viewed East Africa as a strategically important region, economically and diplomatically. Kenya, in particular, has often been described as a key partner, but trade relationships are increasingly where influence is measured. Market access, investment, flows, and supply chains now matter as much as, if not more than, traditional diplomacy. This development could mean that Washington's economic footprint in Kenya faces new competition. While the U.S. focuses heavily on private investment and rules-based trade, China often emphasizes large-scale infrastructure, state-backed financing, and long-term strategic partnerships. For many African governments, the appeal lies in speed, scale, and certainty. It is important to note that Kenya has not announced any intention to cut ties with the United States or Europe. Officials continue to stress that the country is open to all partners and is pursuing a multi-directional foreign policy. In other words, this is not necessarily about choosing sides, it may be about maximizing options. Yet perceptions matter. Headlines framing the move as the U.S. losing Africa reflect a growing narrative that Western influence is being challenged across the continent. Whether that narrative fully matches reality is still debated. What is clear is that African countries are exercising more agency in their economic decisions, negotiating deals that align with their national priorities. From a U.S. perspective, this could mean reassessing how trade relationships with Africa are structured. Preference programs alone may no longer be enough. Analysts warn that without more comprehensive, predictable, and mutually beneficial trade agreements, the U.S. risks falling behind competitors who are willing to offer broader access and long-term commitments. For Kenya, the stakes are high. The success of this deal will depend on implementation. Will Kenyan exporters truly gain improved access to the Chinese market? Will local industries receive support to compete and grow? Will the trade balance improve over time or worsen? These questions remain unanswered. There are also regional implications. Kenya is a gateway to East and Central Africa. Changes in its trade policy can influence neighboring economies, supply chains, and investment patterns. If the deal delivers visible benefits, other countries may seek similar arrangements. If it creates challenges, it may serve as a cautionary example. This development could mean a gradual shift toward a more multipolar trade system in Africa, where no single external power dominates. Instead, countries engage with multiple partners based on specific interests. For global powers, this environment is more competitive. Influence must be earned through tangible economic value, not assumed. As the story continues to unfold, one thing is certain: Africa is no longer a passive player in global trade. Decisions like Kenya's reflect strategic thinking shaped by domestic needs and global realities. Whether this leads to sustainable growth or new vulnerabilities will depend on policy choices made in the months and years ahead. So the question for viewers is this: as Africa reshapes its trade partnerships and global powers adjust to a changing landscape, who will adapt fastest to this new reality, and what kind of partnerships will truly support long-term development? The story does not end with trade numbers or tariff percentages. What is unfolding goes deeper into how power, influence, and economic priorities are changing across Africa. Kenya's move toward giving China nearly full duty-free access is being closely watched not only by Washington and Beijing, but by other African governments facing similar choices. At the center of this issue is control over economic direction. Kenya, like many African countries, has a young population, rising urbanization, and growing demand for jobs. Manufacturing, logistics, and exports are seen as key paths to stability and growth. Any trade deal is therefore judged not just by diplomatic language, but by whether it creates employment, strengthens local industries, and improves living standards. China's economic model in Africa has often focused on large infrastructure projects tied to trade flows. Roads, railways, ports, and industrial zones are designed to move goods faster and cheaper. In Kenya's case, this includes transport corridors linking the interior to the coast, reducing costs for imports and exports alike. Duty-free access fits into this broader structure by making Kenya a more attractive entry point for goods moving into the wider East African region. This could mean that Kenya positions itself as a regional trade hub even more aggressively than before. With lower tariffs on Chinese goods, businesses may choose Kenya as their base for distribution across neighboring countries. Warehousing, transport, and port activity could increase. Supporters argue that this kind of activity generates jobs and government revenue, even if the goods themselves are produced elsewhere. However, analysts warn that being a hub is not the same as being a producer. Without strong local manufacturing growth, Kenya risks becoming primarily a transit economy. In that scenario, profits concentrate in logistics and retail, while industrial development lags. The long-term concern is whether Kenya can move from importing finished goods to exporting higher-value products of its own. Another issue is negotiation power. China is a massive economy with enormous production capacity. Kenya, while influential in the region, is much smaller by comparison. Any imbalance in negotiation strength raises questions about how flexible future terms will be if economic conditions change. Duty-free access is difficult to reverse once markets adjust and businesses rely on it. From a broader African perspective, this deal reflects a growing confidence among governments to negotiate directly with global powers on their own terms. Rather than relying solely on continent-wide frameworks or legacy systems, countries are tailoring agreements to national priorities. This trend signals a shift from dependency toward strategic engagement, even if risks remain. For the United States, this moment is significant. American companies often emphasize quality, standards, and long-term investment returns, but they also face higher production costs and stricter regulatory environments. In markets where price sensitivity is high, this can be a disadvantage. Kenya's move highlights how cost, speed, and scale increasingly shape trade decisions. This could mean that U.S. influence in Africa will depend less on historical ties and more on economic competitiveness. Trade access, financing options, and infrastructure support may need to evolve. Analysts warn that if engagement remains fragmented or temporary, it will be difficult to match partners offering long-term certainty. At the same time, Africa is not turning away from Western markets. Kenyan exports such as tea, coffee, flowers, and apparel still rely heavily on Europe and North America. Diversification is the key word. Rather than replacing one partner with another, Kenya appears to be spreading risk and opportunity across multiple relationships. There are also domestic political and social considerations. Trade deals affect prices, employment, and public opinion. If consumers see lower prices and improved infrastructure, support may grow. If local factories close or unemployment rises, criticism will follow. Public reaction will likely shape how far and how fast such agreements are implemented. Regional neighbors are watching closely. Countries within the East African community share borders, markets, and supply chains. Changes in Kenya's tariff structure could influence cross-border trade dynamics. Some may benefit from increased activity, while others may face competition from cheaper imports entering through Kenyan ports. This situation also feeds into the global conversation about a multipolar world. Power is no longer concentrated in a single bloc. Countries like Kenya are navigating between major economies, extracting benefits where possible. This approach challenges older assumptions about loyalty, alignment, and influence. What makes this moment especially important is timing. Global trade is under pressure from inflation, geopolitical tension, and shifting supply chains. Companies are looking for stability and predictability. Governments are under pressure to deliver growth quickly. Decisions made now could shape economic paths for decades. There is no guaranteed outcome. Duty-free access could accelerate growth, attract investment, and strengthen Kenya's regional role. It could also deepen trade imbalances and test domestic industries. Much depends on policy coordination, enforcement, and long-term planning. Education, skills development, and industrial support will play a critical role. Without these, trade advantages may not translate into sustainable progress. With them, Kenya could leverage global partnerships to move up the value chain. As global powers adjust to Africa's rising economic importance, competition will likely intensify. Deals will become more ambitious and expectations higher. African governments will be judged not by who they partner with, but by the results those partnerships deliver for their people. And that brings us to a final thought. As Kenya and other African nations reshape their trade relationships in a rapidly changing world, will global powers adapt to Africa's priorities, or will Africa continue to rewrite the rules of engagement on its own terms?